Now for your free info kit. 800-969-7766. That's 800-969-7766.
Paid for by Wesley Finance.
This is the Money Matters Radio Network. WBNW 1120 AM and W275CM FM. Concord, Boston. The Money Matters Radio Network.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
New Englanders love the Caribbean, and now there's a Caribbean travel channel available for you to learn all about Caribbean culture while you're planning your next trip to your favorite island. The TravelShareIt.com marketplace is loaded with information about the arts, festivals, food, and music throughout the Caribbean, and is an interactive website featuring daily travel deals to any island of your choice. Book your next Caribbean vacation on the most comprehensive travel channel for the islands, TravelShareIt.com. That's TravelShareIt.com.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
As a busy mom, my to-do list is full.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has information to help you and your family live a healthier life.
Visit goredforwomen.org/momlife today.
Did you outgrow your timeshare and now you want out? But you can't. You can't sell it, and you can't get out of the contract. Imagine trying to get out of your mortgage. That's what a timeshare is. You can't just call up the bank and say, I don't want to pay it anymore. But we may be able to help you do just that. Listen, a timeshare maybe for you once was a great thing, but now you don't use it much. And they are not easy to get rid of. Plus, you do have to pay for it every month. Qualified timeshare owners can get out of their contract legally and permanently without ruining your credit or even filing bankruptcy. And imagine, no more mortgage payment or fees. Call the Timeshare Exit Hotline qualification line now. It's free to learn more.
800-455-7967. 800-455-7967. 800-455-7967. That's 800-455-7967. Paid for by Timeshare Defense.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And today we're talking about your brand new guide, Todd, how to leave assets to your beneficiaries. Todd, how can you ensure that your kids' inheritance can be protected from future divorces?
Well, estate planning, as you know, does things like avoid probate, protect assets from nursing homes, and reduce taxes. But you know what? The family behind the estate plan can be more important. And so the trusts live on after you die, and you can have language in there that divides the assets to the children, but doesn't just pay it out, right? It holds it in trust for them and allows them to be trustee, but just not take it. In order to get it, they have an independent trustee that can say yes or no. And that way, by not owning the asset, if they get divorced down the line after you're dead, and the other side says, hey, I want half of what's in that trust, you're going to say, that's great, but you have to ask the independent trustee. So it's now not going to be available to you. And more than just the ability to say no, it's the fact that you don't own it. So if you don't own it, it's not a marital asset to begin with, so it should not be even subject to the divorce. So learning how your trust works after you die can oftentimes be more important than when you're living, and it does more for you after you die than when you're living sometimes.
The estate planning experts at Cushing & Dolan have been helping families like yours for more than 30 years, and they've written a brand new guide called How to Leave Assets to Your Beneficiaries. To get your free copy of this comprehensive guide, they'll help you determine determine the best way to leave assets to your family, simply call 866-848-5699. That's 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Armstrong do not endorse each other and are not affiliated. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Marc Fandetti.
Wednesday here, Chuck, Mark, and Tucker with you, and continuing to digest what the world looks like now that we've had these new tariffs implemented for the better part of a week in some cases, about a week and a half in other cases. And this morning at 8:30 a.m., we received the retail sales report for the month of March, which obviously, if you pull open your calendar, not while you're driving, please. We want you to stay focused on the road. But if you pull open your metaphorical calendar and you say, oh, gee, March was before the April 2nd tariff announcement date, obviously we are dealing with a set of data that, A, is a little bit out of date, and B, it was something where people were anticipating this April 2nd announcement. We didn't know what was going to come of it. But you did hear from an awful lot of people, gee, like, I'm nervous about this. Do you think I should stock up on that? Like, so you can see a path towards a rebound in the March retail sales data compared to what we had seen for a rather disappointing month of February. And in fact, what we saw was a good March reading, coming in at 1.4% month-over-month gains in retail sales. Fairly broad-based, but somewhat concentrated in, as you would expect, and as we talked about, motor vehicle parts and dealers. Tucker, on Monday, Mike and I had done a little bit of a prediction as to where we thought the motor vehicle parts and dealers number would come in. I believe I was at plus 6.5% month-over-month, and Mike was plus 4?
Correct, 4.0.
We split right in the middle, 5.3%. So that was kind of fun. But in any case, you're not going to see 5.3% monthly gains in auto sales forever, just because there aren't that many people who both need vehicles and can afford to buy them. So I think my takeaway on this report, Mark, is it's a good bounce back from what was a weak February number, which we thought we were going to get anyways, just because February there was so much weather and sickness and everything going around that we were expecting something better. But this is also a data series that is, skewed because of abnormal buying patterns and was before the April 2nd tariff announcement. And so I think in terms of like how much I weight this in my model of what the economy is doing or what it may do, it's one where I discount it pretty heavily just because it's pretty stale at this point.
Yeah, major changes in policy or the expectation of major changes in policy distort the picture. This is obvious, and it's why forecasting becomes difficult in environments like this. There was another set of reports issued this morning, not as widely followed. The Federal Reserve tracks industrial capacity and capacity utilization, industrial production, and capacity utilization. They both declined a little bit month over month last month. That's mainly due, though, to those indices, I should mention, track production at factories, mines, and utilities. Utilities is the key component. Last month it was warmer than average, or than in recent previous months over the same span, that is. So production at utilities declined. It dragged both, as a consequence, industrial production and capacity utilization down. But other categories within these Fed reports, such as orders of business equipment, manufacturing activity, those all ticked up, perhaps also in response to businesses pulling forward demand in anticipation of higher prices soon.
When we look at the retail sales data, when do you think we're going to get a clear look at what the new trend looks like? Because obviously you had, clearly some front running on the vehicle side and maybe some other places as well in terms of the March data. April, anecdotally, we're continuing to hear, I was driving in this morning and I heard 3 different announcements for car dealers, 3 different advertisements for car dealers that were advertising that they had tariff-free models for a limited time. I mean, again, I'm not surprised. Like, anything that you can do to sell a car, like, certainly you're going to. But at what point do you think we're through the initial rush buying and we start to get a sense of the new trend? Because I suspect you're probably, like, you got to be looking at, like, the June, maybe July date. It might be, like, 3-4 months from now.
That assumes we get a clear policy and we stick with it. If policy keeps changing, then people's expectations will keep changing. Retail sales jumped a lot post-COVID, obviously. We're still not back. I'm just eyeballing this. I haven't run the numbers, which I should. But it doesn't look like we're back to the old trend line. We're back to the old growth rate. The slope of the series, so to speak, is the same. That's what I'm eyeballing here.
Sure.
But we're above where we would have otherwise been. Maybe there's more reversion to take place there. It's going to be hard to tease out all these things. So to answer your question, when do we know that the trend is, you asked what I interpret as a broader question, a bigger question, a more general one. When do we know a trend has changed? Whether it's inflation or GDP or productivity, how do you know? You don't have enough data in the moment. You need at least several months in the case of most of these things. GDP only comes quarterly. You may not know for years that a trend has changed. There are different ways to measure the trend if you're a researcher. So the answer, Chuck, the short answer is that you really don't for some time, and even then not with certainty.
In terms of what this means, let's talk about what this means just in terms of setting kind of the baseline for GDP for Q1, because obviously heading into this report, and I haven't seen there's no updated number yet, but the Atlanta Fed has their GDP nowcast that they put out and basically gives you a real-time estimate of, hey, given the information that we've gotten to this point in the quarter, here's where we think GDP is going to be. And what they have at the moment, the Q1 number so far is coming in at negative 2.4%. They do note there was a huge import of gold that happened for technical reasons that has skewed this. And so the adjusted forecast that they give is negative 0.3%. But this is something that obviously a rebound in retail sales would provide a boost there. So I think overall, when we look at this in the context of the broader economy, the message that I think we're still getting regarding the U.S. economy is, hey, the Q1 data is going to show a slowdown from what we were seeing in 2024. As far as how we look forward into subsequent quarters, 2, 3, and 4 of this year, I think we still don't really know exactly how things are going to impact the economy because tariff policy has been in place for a very short time now. There obviously is the possibility that those tariffs change over the coming weeks and months, and we don't know what the magnitude and timing and scope of those changes are going to be. So I think to a certain extent, we're flying somewhat blind over the next couple quarters as far as where we think overall economic growth is going to be, other than to say, in the short term, there's not really a convincing way that you can point to tariffs being accretive to U.S. growth.
I don't think so, but I wouldn't be surprised if GDP exceeded expectations, which are pretty low.
Q2 could be good if you have like a bunch of retail
bonds. Q1. I'm looking at some other. Atlanta Fed's not the only regional Fed bank, as you know, that does a so-called nowcast. Without getting into differences in method, the New York Fed.
No one wants to hear about that.
No, and I'm not the expert, so I'd be the wrong. I'd confuse myself and everybody else. But I can generally say that the methods are somewhat different, but I've never seen a divergence of a few percentage points. And what I mean by that is the New York Fed's nowcast has Q1 GDP tracking, so to speak, at over 2.5%. So
interesting.
Radically different than the Atlanta Fed's conclusion. This points to this divergence points, I think, to the high degree of uncertainty that you were alluding to. It's going to be hard for the next several quarters to get a read on the trend in all of these series that we talk about.
It's going to be pretty noisy. And you could very easily have something where the Q2 data looks great because there's a bunch of retail buying and people trying to get up, get ahead of, future tariffs. There could be something where then the Q3 data is bad because all that buying was front loaded in Q2. Like I know that we often love to react, not us, but like just in general, people love to react to every data point and ascribe like some kind of giant meaning.
We all do it.
I'm not sure how much meaning you can get from data, either good or bad, over the next few months, unless it's like all convincingly in one direction.
Yeah, I think that's a fair statement. We have had a lot of uniformity in sentiment. Stocks pulled back, though they've recovered somewhat. All the leading stuff.
The soft data is pointing towards bad. We have some sporadic hard data here and there.
Well, stocks are, for me, the big piece of hard data, financial market data. I know it's not a real economic data point, as researchers for some reason make a distinction, but stocks, because of the wealth effect and their effect on psychology, to me are...
It's interesting. I view stocks as soft data, personally.
Why do you... Is there a joke?
No. I'm
financial.
I
would put it in a different. Researchers would put it in a different category. The soft stuff is survey based. Financial market data is like a species of its own, and then there's of course economic data, the GDP, the inflation, and then we can get into other subcategories.
I almost feel like stocks maybe there's like a third category you need.
Financial market.
Because on one hand,
it is.
Yes, like it can drive effects in the broader retail economy, not retail, but broader real economy.
Yeah.
On the other hand, it can also be used as a means to express sentiment.
It is both.
It's
There's
kind of
this issue
hybrid.
of chicken egg. There are ways of testing for did the chicken or the egg come first. I don't want to get into those because they don't give you conclusive results either, as you can probably imagine. One of the great debates in financial economics is which causes which. I don't mean causes as in I push you, you fall. I mean causes as in precedes in time and helps to forecast. There's no satisfactory answer there, but I think the weight of the evidence is stocks are a good leading indicator. We don't really need to know why. As a generalist, I don't need to know why. Just give me something that helps my models get better. So I would put a little more weight on stocks maybe than most.
Let's take a quick break. When we return, we'll talk a little bit about Jay Powell. He's going to be giving a speech this afternoon at the Economic Club of Chicago. Mark and I are not invited, but we'll still talk to you about what he may say during that speech.
Market volatility is at its highest point since the pandemic. Keep it here for the most comprehensive coverage of the global trade war. This is the Financial Exchange Radio Network.
The breadth of the stock market sell-off in recent days hasn't been seen since the early days of the pandemic. And while it's easy to say don't panic, if you're concerned about your portfolio, given the impact of these tariffs, now's the time to have that conversation. Hi, this is Mike Armstrong from the Armstrong Advisory Group. If the market correction has you anxious, or worse, rattled, give us a call at 800-393-4001. Let's get together and talk through your financial strategy, evaluate its strengths and weaknesses, and make decisions for the future that are in your best interest. These are challenging times, but we've dealt with them before and are prepared to deal with them again. Our goal is to help you protect the assets that you've worked so hard to attain. You can give us a call at 800-393-4001 and request a no-obligation consultation. That number again is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Consistently voted one of the top Caribbean destinations, the United States Virgin Islands is the perfect place for your next vacation. Whether you're looking for a romantic getaway, a long weekend with friends, or a family vacation, St. Croix, St. Thomas, and St. John have everything you need to enjoy that special time away from home. Take advantage of a variety of incredible promotions that are available right now. Go to visitusvi.com/promotions, where you'll find the details about all of these amazing experiences, including a stay at the Divi Carina Bay all-inclusive beach resort and casino on St. Croix. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Don't miss your chance to enjoy America's Caribbean paradise, the United States Virgin Islands. Head to visitusvi.com/promotions for more information and to book your trip today. That's visitusvi.com/promotions. Beneficiary planning and asset protection go hand in hand. Cushing & Dolan has a new guide out called How to Leave Assets to Beneficiaries, and it can help make your planning process smooth and easy. Leaving your assets to your children isn't as simple as it sounds, especially if they have problems of their own. If you're retired or nearing retirement, it's time to consider the best way to keep your assets in your family while avoiding significant financial consequences down the road. Call Cushing & Dolan right now at 866-848-5699 and get their new guide called How to Leave Assets to Beneficiaries. You'll learn which paths are the safest when it comes to protecting yourself and your children while avoiding unnecessary risks that can create substantial problems in the long run. That number again is 866-848-5699. Or you can request it online from our website, legalexchangeshow.com. That's legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Here at the Massachusetts Department of Elementary and Secondary Education, we are committed to all students not only attending, but succeeding at school. Your presence is powerful. Share why you attend at doe.mass.edu.
Sponsored by the Massachusetts Department of Elementary and Secondary Education.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
Breaking business and financial news first throughout the day. Only here on the Financial Exchange Radio Network.
This segment of the Financial Exchange is brought to you in part by the U.S. Virgin Islands Department of Tourism. The U.S. Virgin Islands are St. Croix, St. Thomas, and St. John, and they are the perfect place to take your next vacation. Enjoy spectacular beaches, world-class cuisine, and a wide variety of water sports. Don't miss your chance to visit America's Caribbean paradise, the United States Virgin Islands. Go to visitusvi.com for more information and to book your trip today. That's visitusvi.com.
Mark, this afternoon, Jay Powell's going to get up in front of the Economic Club of Chicago, and he'll have prepared remarks at 1:30 p.m. and then a moderated discussion afterwards. What are we expecting to hear from him? So I guess here's the thing. The chatter to this point has been, hey, it's early. We're seeing how things are evolving and yada, yada. The point that I'd like to make, and that I've heard some scuttlebutt around, is I think it was either Monday or yesterday, I can't remember when, but Christopher Waller came out and basically had a statement where he's a member of the Board of Governors and had a very dovish leaning set of comments on, I think it was Monday. And Waller, the interesting thing is I think a lot of people have generally viewed him as a proxy for Powell and kind of how Powell is thinking. It's one of these things where like every member of the Federal Reserve, kind of stakes out their territory in terms of, where they are. The guy from St. Louis, Bullard, you always used to know was going to be the most hawkish position that anyone in the Fed could have. Dudley from Boston used to be pretty dovish.
Depends on the conditions, though. I always,
but you have these general, these general lanes that they stay in. So the question that people have been asking the last couple days or so now is, hey, given that Waller had these very dovish comments earlier this week, do we get something similar from Powell today? And does he start talking, more seriously about the prospect of rate cuts at the upcoming meetings?
I don't know. I heard Waller's comments, and I wonder what changes to their assumptions maybe about the long-term so-called neutral rate might be driving him. Maybe he thinks it's come down with tariffs, although you can make an argument that because foreigners will be buying fewer of our treasuries if we're sending fewer dollars abroad. I just made a somewhat technical point there. I'm not saying this is not my area, but if you ship fewer dollars abroad, I feel like I should now elaborate, even though I'm going to get myself further into the the morass here of international balance of payments. But we're sending fewer dollars abroad. That means fewer dollars will come back and buy treasuries and buy factories, et cetera. So if anything, I thought textbook model, if I were answering the question on a test, which I'd probably get a C, I would say the neutral rate would go up. But Waller's comments suggested to me that he thinks something else is going on. I don't know what that is. He didn't elaborate. So, yeah, it may be a preview of what Powell's going to say today. Just keep in mind that inflation, underlying inflation, we talked about trends in the last segment. When we say underlying or long-term, we kind of mean the trend. And it's always hard to get a good read on that because of the noise that you mentioned, Chuck. Underlying inflation remains elevated. I don't see how they can justify cutting aggressively unless they're privy to something bad coming down the pike economically that the rest of us aren't.
And I want to talk about what Waller said specifically. It's just because, A, there's a nice little comparison there that I think is lovely, and B, just to give some specifics. He says, quote, he was talking about, whether he said that he expects the effects of these tariffs could be transitory. And he says, I can hear the hows already that this must be a mistake given what happened in 2021 and 2022, but just because it didn't work out once does not mean you should never think that way again. So, couple different ways to view that.
I agree with that.
The first is, you guys big Arrested Development fans?
I haven't seen it in a while, but yeah.
There's the scene where I forget even the context of it. It's some business that
banana stand?
No. It's some business they're considering. They're like, has this ever worked for anyone? No, but it could work for us. And you read this at first and you're like, okay, let's not go too far here. Well, but there are some key differences in the setup for 2021 and 2022 compared to today. The first is, look, with these tariffs, you do have the potential for some supply chain disruptions. So that's a similarity, actually. Second piece, inflation expectations up. You talk about any survey out there, and inflation expectations are up. So again, two of the three components that we usually talk about in inflation, in the causes of inflation, are present. But there's a key difference that I'll point to. And to this, I'm going to ask a question to all of you who are listening right now. Have you received your stimulus check for the month? And the answer is no, because there haven't been any sent out. And this is a key difference from 2021 and 2022, in that in 21 and 22, we had a huge amount of demand spurred by, quite literally, money that was given to people by the federal government. And that is a stark difference from today, where whether you think that the Trump administration is going to be able to rope in spending or not, spending to this point in the calendar year is basically on par to slightly above last year. There's no meaningful shift that we're seeing in either direction from a federal government perspective. And so, from my perspective where I sit, it is tough to see inflation grabbing a foothold if you don't have that demand piece that's working as well.
Yeah, I disagree completely. Good. But we should talk about this in the next, because there's not enough time to get into it. Can we talk about this after the break? Or
well, we've got 7 seconds.
Expectations
so we can talk about it for 7 seconds if
Researchers
you want.
disagree on the demand versus the supply component. Some researchers, like Ben Bernanke, don't think excess demand had anything to do with the COVID inflation.
Let's take that break right now.
Okay.
And when we come back, we'll
you got
devote
me all
more.
Worked up,
I know, we're going to devote more
off.
than 7 seconds to this when we return, along with Wall Street Watch.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network.
Heads up, athletes, coaches, and parents. Play for life, not just points. Hypertrophic cardiomyopathy, or HCM, is the leading cause of sudden cardiac death, especially in black athletes in sports like football or basketball. If you feel shortness of breath, chest pain, and fatigue, or have a family history of HCM, talk to your doctor. Don't let HCM bench you for good. Learn how to stay in the game at heart.org/HCM student athlete. Your heart, your health, your move.
Leaving assets to your beneficiaries is a critical piece of any estate plan. Cushing & Dolan, the experts in elder law, has written a new guide that may help ensure that your assets are protected for years to come, while helping you avoid unnecessary mistakes during your planning. As an example, the new federal estate tax exemption is nearly $14 million. That could lead to a larger inheritance for your family members, but still raises concerns. There are several strategies in this new guide that will help you learn how to make the right decisions about your distributions at the right time. Cushing & Dolan have been helping New England families for more than 30 years. Let them help you, too. Call 866-848-5699 and get their brand new guide called How to Leave Assets to Beneficiaries. That number again is 866-848-5699. Or you can request the guide online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we have a guide available this month titled How to Build a Retirement Budget. Mike, one of the rules of thumb that gets tossed around is, hey, just withdraw 4% of your portfolio each year and you'll be fine. Is that true still?
It can be, but it also leads to some confusing conversations because that 4% rule, one, is dependent on a very specific asset allocation that was recommended by the person that created it. And two, a lot of those things have changed over time and doesn't really account for the fluctuations that every retiree sees, right? You might retire and not start Social Security right away, in which case your withdrawals could be higher for a period of time.
What about on the other side of the ledger when you look at expenses? A lot of people say, well, I expect my expenses to go down. Maybe I only need 70 to 80% of my pre-retirement income.
Yeah, I mean, this one makes sense, right? Like, you know, you're right now making money. You might be putting money into your 401k, paying FICA taxes that you won't in retirement. But this one especially, I have to say, varies a lot from person to person. That's 70 to 80% of pre-retirement income. And think about it this way, right? Do I still have a mortgage? Might that mortgage get paid off at some point in my retirement? What sort of debts do I have? Am I going to downsize to one car? Are we going to need both? What sort of travel am I planning on? And so that 70 to 80% rule can be a good starting point, but really you need to start with the budget.
Our guide is titled How to Build a Retirement Budget, and the way to request it is by calling 800-393-4001. That number again is 800-393-4001 to request our latest guide, How to Build a Retirement Budget.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Time now for Wall Street Watch, a complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Markets are in negative territory as investors react to the March retail sales report, where retail sales climbed 1.4% last month, in line with estimates. Wall Street will also be turning their attention to Fed Chairman Jerome Powell at 1:30 this afternoon, where he will deliver prepared remarks on the economy, followed by a moderated discussion at the Economic Club of Chicago. Right now, the Dow is down by 0.5%. S&P 500 is down just over 1% lower. And the NASDAQ down nearly 2% lower at 317 points. Russell 2000 selling off by over 0.75%. 10-year Treasury yield is up by 2 basis points at 4.34%, and crude oil up 2% higher so far today, trading at $62.54 a barrel. Tech sector pulling back today as a result of news surrounding chip makers Nvidia and ASML. Nvidia warned it will report about $5.5 billion in related charges due to the fiscal first quarter. During the fiscal first quarter, after the Trump administration barred the company from selling its H20 chip in China. As for ASML, the company reported weaker than expected orders for its chip-making machines in the first quarter and warned that tariff policies were creating uncertainty for the industry. Both of those stocks are down by 6%. Other chip makers, including AMD and Broadcom, also seeing losses as well. Meanwhile, United Airlines surpassed first quarter expectations, where the airline swung a profit and posted higher quarterly revenue. The company said it would reduce flights and aircraft in anticipation of lower travel demand and a potentially weaker U.S. economy. United is up by 1%. Heineken reported better than expected revenue and growth and confirmed its annual guidance despite warning of uncertainties ahead due to tariff policy. Heineken up 5% overseas. Travelers posted better than expected first quarter earnings, sending shares in the insurance company up by 4%. J.B. Hunt down by 7%, where the transportation company reported a 1% drop in revenue and operating income year over year. And after today's closing bell, we'll see quarterly earnings from CSX and Alcoa. I'm Tucker Silva, and that's Wall Street Watch.
Mark, just before the break, I made a statement to the effect of, hey, one of the things that is missing in this economy that was present during the inflation that we saw in 2021 and 22 was a huge surge in demand. I believe your response was something along the lines of, how dare you say something like that? You have offended the economic gods, and you shall be struck down by a bolt of lightning from Ben Bernanke's eyeballs.
Smited.
And
no, first of
thus,
all, you're right, though.
Well, no,
we're not overstimulated.
Stick to your guns,
Mark. No. Let me first. No, I should be a little bit more balanced before
If we're going to have an economics debate, we're going to have an economics debate.
That's not the way researchers talk, even on the radio.
I know.
Plus, you're my boss. So, no, you're always very fair in this forum. This is a place where we can speak freely.
Yes.
So you're right. There's no big demand shock this time, but there are two components to the demand-supply relationship. The other is supply. Demand, if you think about total demand in the economy, sometimes you hear that referred to as aggregate demand. Think about total demand not moving, but the ability of the economy to satisfy that demand, so-called aggregate supply, which is just the counterpart. It's just taking one market, like you learned in undergraduate, macroeconomics, where you took the market for pizza or something, which is the classic illustration, I guess, because everybody can relate to it. Just expand that to every good in the economy. Aggregate demand, aggregate supply. Suppose nothing happens to aggregate demand. They don't lower taxes beyond where they are today. They just continue the tax cuts. Suppose the Fed doesn't overstimulate, which can also push aggregate demand in an unfavorable from an inflation point of view, direction. Aggregate supply, total supply, again, just a fancy way of saying it, could contract. So due to tariffs, due to snarling supply chains and stuff. So even without reckless fiscal policy like the Biden regime imposed, or the Trump regime, first Trump regime imposed at the end. I don't want to pick on one or the other, and maybe you thought it was a good idea politically, but not a good idea from the point of view of inflation. Even if demand doesn't get goosed by monetary or fiscal policy, supply could still shift in an unfavorable direction. If you're picturing this, which I do, you're probably not, but it moves to the left. That pushes output below potential. You get recession, in other words. That could also push inflation above where it is today. The combination of those two things is known as stagflation. So I'm not saying you're wrong. You're right. The federal government doesn't appear to be dumping. I said to assume that because we're not going to have a helicopter drop of money again, which is what Trump won and then Biden did. Biden more recklessly than Trump won. I do put most of the blame there. But there are some researchers, Ben Bernanke is a household name, which is why I keep mentioning it, but there are others who say, no, COVID inflation was not about demand. It was totally about supply. And they apply pretty sophisticated statistical techniques to come to that conclusion. It's not just their opinion. I think that's wrong, and so do others, but who cares what I think? Point is, Chuck, inflation is not well understood. It's a little bit mysterious. This is both depressing because we've been at this since the great inflation of the 70s and we still don't have a good answer as to what causes it. Why does it persist? Why precisely do expectations matter? How do they channel their way into the actual inflation process? These things are not well understood, and just when we think we understand them, relationships change and we're proven wrong. So the best prescription here, not just with respect to inflation, but any economic variable, including the stock market, is, as always, humility.
Let's talk a little bit more about what Tucker mentioned during Wall Street Watch, where we've got a sell-off happening in the semiconductor space in particular. You take a look through there, Nvidia's down about 6% today, AMD down 6%. Basically, semis are kind of dragging the rest of the market right now. The reason being, Tucker noted that Nvidia announced that they were going to have a $5.5 billion charge related to the fact that they are now not able to sell their previous generation of chips into China. ASML, who is the manufacturer of the what's called lithography equipment for making semiconductors. So basically, they're the company that makes the equipment so that other people can make semiconductors. Which isn't it fascinating? I mean, I just want to diverge for 1 second. And I know that this is how it is in like most industries in terms of, not everyone's vertically integrated, but it's wild to me that someone has such precision and scale that they make these machines, but they don't operate them themselves. And I know that's how it is everywhere. It's kind of like how, Caterpillar doesn't go out and actually like dig lithium mines and stuff
Boeing
like that.
Or Boeing doesn't fly the planes.
Right.
Yeah.
But, they used to.
Oh, really?
So the interesting thing is that Boeing, United Airlines, and United Technologies used to be one company. And then they split off back in the 50s, I think it was.
Oh, okay. I didn't.
But Boeing, United Airlines, and United Technologies were all one company originally before they split off. So Boeing did actually used to fly their own planes back in the day, 70 years ago.
I picked one example, and it was wrong.
And it's probably the only example where I could give you something that was wrong also.
That worked out really well, though.
But anyways, it was probably a dumb comment by me because in thinking about it, it's like, obviously Caterpillar doesn't operate the mines. But, so you've got ASML. They guided towards basically a lower than expected number, going forward. And so we're continuing to get data points that are suggesting from an AI and semiconductor perspective, we're kind of not at the peak of the stocks, but like the peak of the acceleration of CapEx in that space. There's just not enough money in the world to continue accelerating at 80%, 100% annual growth rates up as far as spending on data centers and stuff like that.
Particularly if we're telling foreigners, take your money. We don't want it. We're not going to buy your exports. I keep coming back to the trade deficit and how this ties into investment, but you really have to, I think this is a good teachable moment. It's for me too, by the way. This is not my area, so I'm going back and trying to relearn this stuff. If you tell foreigners we're not going to buy your stuff, that we're not giving them dollars, they can't reinvest in treasuries. I know I said this in the last segment, so sorry. They also can't help our companies make the investments they need in data centers or whatever. This is why this is probably long-term not great for interest rates. Well, it's great if you want them to go up.
Let's take a quick break here. When we come back, we'll talk about the latest in the U.S. and China trade spat. We'll talk about what we saw overnight and where things may go from here right after this.
Tariffs fears continue to grip markets. Get the latest straight from Wall Street right here on the Financial Exchange Radio Network. Consistently voted one of the top Caribbean destinations, the United States Virgin Islands is the perfect place for your next vacation. Whether you're looking for a romantic getaway, a long weekend with friends, or a family vacation, St. Croix, St. Thomas, and St. John have everything you need to enjoy that special time away from home. Take advantage of a variety of incredible promotions that are available right now. Go to visitusvi.com/promotions, where you'll find the details about all of these amazing experiences, including a stay at the Divi Carina Bay all-inclusive beach resort and casino on St. Croix. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Don't miss your chance to enjoy America's Caribbean paradise, the United States Virgin Islands. Head to visitusvi.com/promotions for more information and to book your trip today. That's visitusvi.com/promotions.
One of the keys to enjoying a peaceful retirement is flexibility. Hi, this is Chuck Zodda from the Armstrong Advisory Group. Today, retirement planning involves lots of possible changes and challenges given all of the external factors that may affect your goals. So creating a budget for your retirement is vital to financial stability. Retirement comes with a number of monetary considerations, from how much money you'll need every month to managing your existing investments through market volatility. Our new guide is called How to Build a Retirement Budget, and it will offer a variety of options for your consideration that may lessen your risks when it comes to your planning. Call right now at 800-393-4001 and ask for our new guide today. That's 800-393-4001, or request it online from our website, armstrongadvisory.com. That's armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Leaving assets to your beneficiaries is a critical piece of any estate plan. Cushing & Dolan, the experts in elder law, has written a new guide that may help ensure that your assets are protected for years to come, while helping you avoid unnecessary mistakes during your planning. As an example, the new federal estate tax exemption is nearly $14 million. That could lead to a larger inheritance for your family members, but still raises concerns. There are several strategies in this new guide that will help you learn how to make the right decisions about your distributions at the right time. Cushing & Dolan have been helping New England families for more than 30 years. Let them help you, too. Call 866-848-5699 and get their brand new guide called How to Leave Assets to Beneficiaries. That number again is 866-848-5699. Or you can request the guide online by visiting LegalExchangeShow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
Miss any of the show? Catch up at your convenience by visiting financialexchangeshow.com and clicking the on-demand icon, where you'll find all of our interviews and full shows. This is your home for the latest business and financial news in New England and around the country. This is the Financial Exchange Radio Network.
Overnight, it was, I think, around 4:30 a.m. Eastern Time. China indicated that they would potentially agree to trade talks, but they wanted the Trump administration to show them more respect. They also wanted a designated point person named on those trade talks. And we did see overnight, I can tell you, if you look at how futures traded overnight, stock futures rallied about 1% during that time, obviously still open down and still are down, but it was looking like it could have been a worse day before this. And to me, it suggests that there still is just a ton of optimism in markets that some kind of deal gets done here. But I think a couple things can be true. The first is that the Trump administration, I think, really wants more than anything else to squeeze China through tariffs. Like, China is clearly the primary target of just about all of this. Everything else, I think, is kind of noise. Not saying it's not meaningful noise, but it's noise. I think it also is something where I'm not entirely sure that that either side wants a full decoupling at the snap of a fingers, which is basically what these level of tariffs are when you talk about the volume of trade that is just not going to happen between them. And the other piece is, okay, you could potentially get some good news where, sure, the Trump administration agrees to negotiations and maybe both sides agree to, reduce tariffs to a certain percentage during those negotiations. But if you're talking about the big, heavy items that the Trump administration wants, to be completely honest, I'm somewhat convinced that they need to maintain maximum pressure during negotiations in order to try to get those things, just because we've seen before from the Chinese government where, okay, they come to agreement X, Y, or Z, and then they don't follow through on it. And so you're sitting there like, what the heck did we end up doing here? So I think just trying to put this in the context of broad markets, the market is clearly desperate for some good news on China. I'm just not sure that the good news that can be delivered is good enough to be able to satisfy markets eventually, but we'll see. I have no idea how this is going to play out. No idea.
Yesterday, I used the term chimerica. I didn't invent it. It was invented by Neil Ferguson. I know you don't love him as a historian,
he's okay.
I'm just
He's fine.
I'm giving you the provenance of the term. He coined this 20, 25 years ago, this hybrid term, chimerica, because we have been coupled for 30 years. Our savings rate has been going down, and that could be federal government. I'm talking about total savings, which is government plus all of us. So we don't save enough to satisfy investment demand in this country. I know I'm repeating myself from yesterday, so sorry if you heard this. That means we have to import capital to grow our economy at the clip that it has grown historically, which is pretty much the envy of the world with the exception of developing markets. But we're a very fast economy we're a very fast growing economy given our size. China has satisfied that demand. They buy treasuries. They make other investments. The flip side to that is the trade deficit. So I'm trying to filter most of this out. I don't think it matters unless we change the balance of payments more broadly. We need to start saving more that at both the federal level and individual. Otherwise, this decoupling, it really can't. I mean, we could try to make it happen, but then our trade deficits with other countries, India, other potential low-cost venues for the trinkets that we buy from China, it'll just find another source of supply, and then we'll be picking on India in 5 years or something.
Beneficiary planning and asset protection go hand in hand. Cushing & Dolan has a new guide out this month. It's called How to Leave Assets to Beneficiaries, and it can help make your planning process smooth and easy. Leaving your assets to your children isn't as simple as it sounds, especially if they have problems of their own. If you're retired or nearing a retirement, it's time to consider the best way to keep your assets in your family while avoiding significant financial consequences down the road. Call Cushing & Dolan right now by calling 866-848-5699 and get their new guide called How to Leave Assets to Beneficiaries. You'll learn which parts are the safest when it comes to protecting yourself and your children while avoiding unnecessary risks that can create substantial problems in the long run. That number again is 866-848-5699, or you can request the guide from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
Mark, I saw something yesterday that I've never seen a company do before. Maybe other companies have, and I just am not familiar with it. United Airlines, they had their earnings report after the bell, and what they did is they basically came out and said, not basically, they came out and said, hey, if there is a recession, this is what we expect our earnings to be. If there is no recession, then we reaffirm our prior guidance, which I'm not really sure how useful that is, because like, isn't that kind of like me saying, hey, if it rains tomorrow, I'm going to eat ham. But if it doesn't rain tomorrow, it's turkey all day.
Well, you're saying I'm not a meteorologist, so you plug your own belief with respect to the weather tomorrow in, and that will tell you what I'm going to do. I sort of liked it. As if you're a forecaster, you give like a prediction interval. You say, well, it could be this or it could be that. 95% chance in between. I kind of like this. They're saying we're not economists. So if there's a recession, something over which we have no control, this will be our result. If there's not, this will be our result. You pick the one you think is more likely. It feels like a cop-out, but I sort of liked it.
I guess it feels like a cop-out because why are they doing this now? Like, out of all of the other times when people have been concerned about recession or not, like, why now? Like, they've never done this before. I've never seen any company do this before. Like, have you ever seen a company give a conditional earnings guide? No,
but we always discount it. So maybe this is more realistic, humble. And it's less useful unless you have your own prior belief on recession that you can plug in. I don't know. I just kind of liked it. It was kind of refreshingly
I would say
honest.
Pull your guidance.
Okay.
And this is where I would go is, hey, if you don't know how much you are going to earn, tell us you don't know how much you are going to earn.
I think they did, without saying as much.
But then why is the guidance actually useful? Like, what are you actually guiding?
It isn't really unless you have a strong view.
Here's where this is going to end up. Here's the funniest possible situation is, okay, so they guided, like, if there is no recession, I forget the exact numbers, it's going to be like $11 to $13 a share in earnings. If there is, it's going to be like $7 to $9 a share in earnings. They're going to end up printing like 10. It's going to be right in the middle of those ranges where they like didn't give any guidance or something. Obviously, like, who the heck knows, but I don't know, like, what do I do with this?
I hear you. I still like it.
The piece that is interesting, and this is, again, something that is very much not priced into markets, they are telling you, hey, if there is a recession, our earnings are going down 35 to 50%. That's a meaningful data point. Quick break here, hour 2 coming up in a bit.
Retirement planning is complicated enough without having a formal budget to help you maintain your lifestyle during your later years. This is Mike Armstrong from the Armstrong Advisory Group. Our new guide called How to Build a Retirement Budget was written specifically for this purpose. Our goal is to help take your financial concerns out of your retirement years. There are numerous issues to deal with when creating a retirement budget. Everything from understanding where your income will come from, to setting up a proper withdrawal strategy, to being able to remain flexible as market conditions change. This new guide offers structural guidance that may alleviate the pressures of creating your budget. You can request your copy right now by calling 800-393-4001 and ask for our new guide today. Once again, that number, 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
New Englanders love the Caribbean, and now there's a Caribbean travel channel available for you to learn all about Caribbean culture while you're planning your next trip to your favorite island. The TravelShareIt.com marketplace is loaded with information about the arts, festivals, food, and music throughout the Caribbean, and is an interactive website featuring daily travel deals to any island of your choice. Book your next Caribbean vacation on the most comprehensive travel channel for the islands, TravelShareIt.com. That's TravelShareIt.com. This is the Money Matters Radio Network, WBNW 1120 AM and W275 CM FM, Concord, Boston. The Money Matters Radio Network.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
Are you over the age of 50? Want peace of mind and financial security for your family? Here's an important message to you from Senior Care USA. The average funeral now costs over $10,000. That leaves your loved ones the burden of paying your debts and funeral costs. Our plans start as low as $1 per day and will pay your family up to $30,000 to help pay for your funeral and other expenses. There are no medical exams. Your rates will never increase, and your plan cannot be canceled, regardless of your medical conditions, as long as you make your premium payments. Get up to $30,000 in final expense insurance. Call now for free information. Just answer a few simple questions and get approved right over the phone in just a few minutes. Call right now.
Call 800-378-3818. 800-378-3818. 800-378-3818. That's 800-378-3818. Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
Consistently voted one of the top Caribbean destinations, the United States Virgin Islands is the perfect place for your next vacation. Whether you're looking for a romantic getaway, a long weekend with friends, or a family vacation, St. Croix, St. Thomas, and St. John have everything you need to enjoy that special time away from home. Take advantage of a variety of incredible promotions that are available right now. Go to visitusvi.com/promotions, where you'll find the details about all of these amazing experiences, including a stay at the Divi Carina Bay All-Inclusive Beach Resort and Casino on St. Croix. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Don't miss your chance to enjoy America's Caribbean paradise, the United States Virgin Islands. Head to visitusvi.com/promotions for more information and to book your trip today. That's visitusvi.com/promotions.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange Quick Tip of the Day. And today we're talking about your brand new guide, Todd, how to leave assets to your beneficiaries. Todd, why can't you just add your kids to your accounts or to your house deed?
Well, you can. It's just not a good idea. So people who do that understand with an account, right, you can put a joint name on the account. Now, that doesn't actually complete the gift because you actually have to take the money out and then the gift is complete. But when you set it up, yeah, the asset would avoid probate. But if something happens to the child, it's going to be, available. Half the asset would be subject to the children's creditor. So you don't want that. And secondly, if you only put one kid on the deed, you've likely disinherited the other kids. So it's not really good planning overall. Whereas if you put the house in the kid's name, now you've actually made a completed gift of half the house and would need to file a gift tax return, number one. Number two, of course, it's exposed to the child's creditors and, yes, divorces. You could find yourself at some point owning half your house with an ex-in-law. Not sure that's a good way to plan. So please, put together trusts. Don't just throw names on deeds or on bank accounts because, as I always like to say, nothing good comes from giving assets away while you're living.
The estate planning experts at Cushing & Dolan have been helping families like yours for more than 30 years, and they've written a brand new guide called How to Leave Assets to Your Beneficiaries. To get your free copy of this comprehensive guide that will help you determine the best way to leave assets to your family, simply call 866-848-5699. That's 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Marc Fandetti.
Hour number 2 here on the Financial Exchange. Chuck, Mark, and Tucker with you. And we got stocks selling off today, with most of that sell-off concentrated in the tech sector. The tech-heavy NASDAQ down 2.06%, 345 points. The S&P 500 down 61 points, or about 1.1%. The Dow Jones Industrial Average down 132 points, or about 1/3%. So not too much movement in the Dow, but the S&P and NASDAQ struggling a little bit more. 10-year U.S. Treasury not moving at all today. Actually, it's moving 0.6 of a basis point, so 0.006%. But it is basically stable at 4.329% at the moment. The national 30-year fixed-rate mortgage average currently sits at 6.88%, down 0.1% as bond yields have come in a little bit in recent days, but still higher than, the 6.6% range we were sitting in a few weeks ago. When we take a look at oil, West Texas Intermediate is rallying $1.24 a barrel to $62.57 right now. And the AAA national average for gas prices continuing to slide, down another 0.4 cents overnight to $3.16 and 0.9 cents. Still up around 9 cents over the last month in terms of what we are seeing there. And gold continuing to break out to all new all-time highs, up $83.40 an ounce to $33.23 and 80 cents an ounce. So gold continuing its absolutely just, ridiculous start to the year as it continues to surge ahead here. We got a piece in the Wall Street Journal, and it's titled, How Supreme Court Ruling Could Weaken Fed Independence and Shake Markets. And what we're talking about here is actually not a case that is directly related to the Fed, but rather it is focused on other agencies that currently, not agencies, but other, what's the technical term, Mark, of like what the Fed is considered? It's not an agency, but it is.
Is it quasi-governmental?
Yeah, kind of these.
It's independent for now.
But what are they called? like, what would we? It's the Fed's not an agency. It's a.
I would have said quasi-independent entity. I don't know. Let's just Google that.
Because, again, the distinction does matter here.
Yeah, I don't know. It could be characterized that way, but yeah. Well, go ahead. You're getting to the
So
meat of
basically,
this.
there are a few of these different entities that have multi-member boards that oversee them. Think about the NLRB, the FTC, the Federal Reserve, these types of entities. And there's a precedent that was set back in 1935. It's in a case called Humphrey's Executor, which, it sounds very much out of 1935. But the basic premise, it really does. The basic premise there is that the Supreme Court at the time barred FDR from firing members of the FTC for purely political reasons. And the reason why was they were not conventional executive branch employees in this ruling. Instead, they kind of filled this quasi-judicial role is kind of how they fit. So the Trump administration is challenging that ruling. And the reason why this is coming up is that President Trump fired a member of the NLRB and a member of what's called the Merit Systems Protection Board as well, the MSPB. And both of those people are suing, arguing that the filings are illegal by virtue of this precedent from 1935. At the moment, the Supreme Court has said, look, we're going to let the firing stand while we consider this, and briefs in the case were due yesterday. Now, why does this matter to the Fed and financial markets potentially? And the reason why is the Fed is set up similarly in terms of having, again, kind of this not conventional executive branch appointee role. It's just it's a different setup than you typically see. And this forms kind of the basis for the idea that the Fed is completely independent and operates, kind of beyond the whims of any politician who sits in the Oval Office. The reason that this matters is, let's look at, a few hypothetical situations. Let's say that the Fed is determined, or let's say it's determined that the president can fire members of the Fed at any point in time for purely political reasons. So, things that you can do, then you can appoint exactly who you want, whenever you want, basically, as long as you have control of the Senate, because Fed chairs are Senate confirmed. And pretty much what it allows you to do then is to have more direct control over monetary policy from the White House. Now, some of you listening might be like, hey, it's not a bad thing. Like, President Trump might be great at doing this. Some of you listening might be saying, hey, I don't want President Trump to be doing this. Forget about like your specific politics for just a second. And now remember them in a different way, actually. Imagine that the person who you would least like to be president has this power. For some of you, that might be Bernie Sanders. For some of you, that might be Fidel Castro. For some of you, it might be an alien from Mars. Whoever it might be. But imagine that someone that you really, really don't want to be president has the power to set monetary policy. Would you feel comfortable with that level of power vested in them to make those decisions for the country as a whole? How much power are you comfortable giving to one person if they don't share your views?
Fed hasn't always been independent, only since 1951, and even after 1951. Prior to that, they were charged. Let me step back. Congress has the power to create money. Congress gave that power to this independent entity. It wasn't vested in the executive. It is an Article 1 power. Google it. Very easy to read. Congress coins the money. They said, much like with regulating these specialized areas, we're going to farm this one out. with oversight. We're going to farm it out. We need expertise. So they created the Fed in 1930. There were other central banks, and various presidents vetoed or vetoed bills to recharter them, etc. The result was usually calamity. So after a long and painful experience, we created a Fed in 1913 after World War II and the big inflation that followed. It was brief, but it was big. The Fed broke away from the Treasury. No, we're not going to print money to buy debt. The Fed gradually became more independent over the next 30 years. It culminated in Paul Volcker, who Jimmy Carter appointed, Ronald Reagan reappointed. So bipartisan agreement that an independent, assertive Fed with the power to squash inflation was a good thing. So start with that premise. An independent Fed is a good thing. You've got to accept that. Every researcher who's ever looked at the issue globally has found inflation is higher when independence is lower, or said differently, the more political control over a central bank, which is what the Fed is.
And isn't the reason why because every politician wants lower rates?
What are you going to do? Raise rates if you're a politician? What are you, nuts? Of course, they're going to print money.
Hey, here's how would it affect my reelection chances if I raised interest rates?
No politics. And we've had recent experience with this with Richard Nixon keeping pressure on his buddy, Arthur Burns, who was also a very accomplished economist and well-known, in economic circles. So he wasn't some hack. Even he couldn't resist at first, Richard Nixon. And we had, as a result, a bigger inflation in the 70s than we probably otherwise would have. It wasn't the sole culprit. There were many, but it contributed to it. So it took us like almost 50 years to get to this point. So whatever you think, Chuck, as you said, and I think you put it perfectly, whatever you think about a particular individual's competence, imagine someone who's not competent. It's like you may think that all these expansions of executive power, I'll give you a parallel. Maybe your thing is not monetary policy. Maybe your thing is executive power. I'll say what I think somebody said at the Constitutional Convention. George Washington's sitting there. They're designing the executive. And he said, don't look at that man. He's perfect. Think of a scoundrel in that office when you're designing the executive. And that's what you have to keep in mind when you're thinking about the Fed.
Imagine if you get stuck with me as president. Do you want to give me that power? I don't.
Any one of us doesn't have the perspective.
No.
Any one person, which is the value of checks and balances, feedback.
So this is something where I don't know the exact timeline. It's probably going to be, in the next month or so that we end up getting a ruling on this. But it has the potential, if the Supreme Court rules that, members of these boards are able to be fired by the president, it has the potential to shake up monetary policy in a way that we have not seen in our lifetimes.
Yeah, it's
quite
unclear
honestly.
what he would do. Would he appoint himself? I don't think so.
Probably
it's a big
not.
job. Would he appoint Kevin Warsh? Is a name that's been bandied about. That's fine. He's a respected. He's not quite a researcher, but
he very well may be the next Fed chair, anyways. When Powell's term is up,
why turn the markets upside down by firing Powell and creating the uncertainty?
It's more. It's not even the specific decision around what the president may or may not do now. It's much more the can of worms that it opens about what any president could do at any point in time.
Yeah, and it's one of those issues, Chuck, that's so obscure and inaccessible. I wouldn't know a thing about it if I didn't kind of do this for a living and wasn't interested. But go ahead, what?
The average American has 400,000 other things they're thinking about before this.
No, if you ask a person on the street, what is the Fed?
And they should. They shouldn't be spending their time worrying about this.
But it is critically important. There's probably a teachable moment here. We may have to lose Fed independence to remember why we fought so hard to get it. Just like with some of these other, I don't want to verge into the political, but sometimes you got to lose rights to appreciate them and fight to get them back. That may be where we end up with the Fed. I hope we don't have to learn that lesson again.
Let's take a quick break. When we come back, we'll do a little bit of trivia, and then we're talking Boeing right after this.
Tariff fever is in high gear. We've got the latest on what might be next and how long it might last. Only here on the Financial Exchange Radio Network. It's easy to say that you're simply leaving your assets to your children, but without proper beneficiary planning, it can cause significant problems. Call Cushing & Dolan at 866-848-5699 and get their new guide called How to Leave Assets to Beneficiaries. Don't leave your future or your children's future to chance. Call 866-848-5699 or request it online from our website, legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
Retirement planning is complicated enough without having a formal budget to help you maintain your lifestyle during your later years. This is Mike Armstrong from the Armstrong Advisory Group. Our new guide called How to Build a Retirement Budget was written specifically for this purpose. Our goal is to help take your financial concerns out of your retirement years. There are numerous issues to deal with when creating a retirement budget. Everything from understanding where your income will come from, to setting up a proper withdrawal strategy, to being able to remain flexible as market conditions change. This new guide offers structural guidance that may alleviate the pressures of creating your budget. You can request your copy right now by calling 800-393-4001 and ask for our new guide today. Once again, that number, 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Consistently voted one of the top Caribbean destinations, the United States Virgin Islands is the perfect place for your next vacation. Whether you're looking for a romantic getaway, a long weekend with friends, or a family vacation, St. Croix, St. Thomas, and St. John have everything you need to enjoy that special time away from home. Take advantage of a variety of incredible promotions that are available right now. Go to visitusvi.com/promotions, where you'll find the details about all of these amazing experiences, including a stay at the Divi Carina Bay all-inclusive beach resort and casino on St. Croix. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Don't miss your chance to enjoy America's Caribbean paradise, the United States Virgin Islands. Head to visitusvi.com/promotions for more information and to book your trip today. That's visitusvi.com/promotions.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
Cardiovascular disease is the #1 killer of women,
taking the lives of 1 in 3.
That's more than all forms of cancer combined.
For too long, heart disease and stroke have taken the lives of the women we love.
But we're not giving up.
Because we have something better.
Stronger, more powerful.
We have each other.
When we come together and go red,
the more power we have against our greatest health threat.
Visit GoRedForWomen.org today to learn more.
The Financial Exchange streams live on YouTube. Like our page and stay up to date on breaking business news all morning long. This is the Financial Exchange Radio Network.
All right, time for trivia here on the Financial Exchange, and today is Bill Belichick's 73rd birthday. Excuse me. The former Patriots and Browns head coach will begin his first season as a college football coach later this year. Trivia question today: which college football team is Bill Belichick the head coach of? Once again, which college football team is Bill Belichick the head coach of? Be the 8th person today to text us at 617-362-1385 with the correct answer, and you get a brand new Financial Exchange Show t-shirt. Once again, the 8th correct response to text us at 617-362-1385 will win that t-shirt. See complete contest rules at financialexchangeshow.com.
So, Boeing has had kind of a bad decade.
Yeah, century maybe so far.
Not a full century.
No, but well, to this point, yeah.
It's been, I mean, look, the stock as it sits right now is at $155 a share. It was basically there in November of 2015. So, yeah, they've had kind of a bad decade. The vast majority of it has been of their own creation through the mismanagement of the 737 MAX program that led to 2 of those planes crashing. Some of it has been, factors outside their control. Obviously, the whole pandemic disrupted air travel and this and that. And now they're once again facing something outside their control where Boeing is sitting there and they're going, okay, so yes, we manufacture these planes in the United States, but a lot of our suppliers are located in foreign countries. We've got a company that makes this part of the plane is in Mexico, this part's in Canada, this part's in Switzerland. We ship it to South Carolina, and boom, you got a 787.
Boom.
The thing is, those inputs are now being taxed for them.
Whoops.
So you've got higher input costs. On the other side, China announced yesterday, hey, we're pausing all deliveries of Boeing jets. So now you don't have, those deliveries potentially happening. They've got enough of a backlog where they can work around that in the short term. But you also are, figuring, hey, when I'm sure there's one plane that's on the assembly line that you're painting in, whatever Chinese airline livery that you're, painting on there, that now you got to go back and repaint and, maybe the chair, you got to redo the interior because you got to deliver it to a new customer.
Would you ship it missing a few parts? I'm kidding. I don't know how they do things.
But, anyways. So here's the big thing is Boeing is really being squeezed right now because their costs are going up. A major market is saying, hey, we're closed to you at the moment. And this is after years where, the environment's been really challenging for them to operate in. Again, some of their own doing and some of not. But you sit there and you're kind of like, what do you, like, what's the path to Boeing just having like a good old boring path forward here? And it's kind of hard to see what that looks like for them at this point. It's just a mess.
Yeah, that's kind of the writ small, or is it writ large if you're talking about smaller companies? Whatever. It's representative is my point, right? Every company, we don't make stuff in finance, obviously, so we're in somewhat, at least I am, somewhat of a bubble. We talk to investment managers who buy companies that make stuff, and it's very revealing to reconnect with the real world, people who order physical inputs and have to think about their sales not just 6 months or a year, but 2, 3, 5 years out.
Sure.
It's all visibility is always cloudy. It's especially so now. One sympathizes with Boeing, but it's not just their predicament. They're just, I guess, uniquely hampered by all of this. I don't know what else to say. That's not a really deep insight.
I liked it, though. It's fine. The other thing that's interesting in this is, okay, so let's say that China decides that they're going to keep this, prohibition on taking deliveries of Boeing planes going forward. There are U.S.-based suppliers, GE and Honeywell, that are currently providing parts to China's attempt to get into the commercial jet market. If you look at the history of China trying to do this, it's messy because it's really hard to build commercial-grade aircraft that meet the requirements from a safety and reliability perspective and also are cost competitive. China's been trying for decades to do this. The iteration that they have right now is something called the C919. It's made by the Commercial Aircraft Corporation of China. And it's not something that has gained, any kind of meaningful traction because basically whenever you are flying a new airplane, there are a ton of different certifications that you need just in order for it to be able to fly in different regions. And beyond that, you also then have to get all of your pilots certified to fly it. They can't just say, oh, I fly a 737, let me go fly this. So here's the thing. The deliveries that they have made to this point in 3 years of these planes are 16 planes. 16 planes is nothing. It is a drop in the bucket. Boeing does 16 planes in a week. Just to put this in perspective in terms of the scale here. So there's just not that much there as far as their ability to actually produce these. They claim that they have 1,000 orders that are on file, all for basically Chinese airlines that are going to operate these, but they can't actually deliver them in any meaningful quantity because I guess the basic way to put this is it's hard making airplanes, yo. So ultimately, the question that comes out of this is, okay, if China is going to say no Boeing deliveries happening here, does the U.S. respond in kind by saying, fine, you're not getting any GE or Honeywell parts to build your domestic airplanes? Seems like turnabout's fair play, but it's again, this is why this
Trade
stuff
wars
gets
are
really
stupid.
messy, and it gets messy very, very quickly here. Let's take a quick break. As we head towards the bottom of the hour, stocks trying to rally with the Dow now in positive territory, but the S&P and NASDAQ still down. We've got the trivia answer after this, and then we're talking car buying.
Bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network. Consistently voted one of the top Caribbean destinations, the United States Virgin Islands is the perfect place for your next vacation. Whether you're looking for a romantic getaway, a long weekend with friends, or a family vacation, St. Croix, St. Thomas, and St. John have everything you need to enjoy that special time away from home. Take advantage of a variety of incredible promotions that are available right now. Go to visitusvi.com/promotions, where you'll find the details about all of these amazing experiences, including a stay at the Divi Carina Bay all-inclusive beach resort and casino on St. Croix. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Don't miss your chance to enjoy America's Caribbean paradise, the United States Virgin Islands. Head to visitusvi.com/promotions for more information and to book your trip today. That's visitusvi.com/promotions.
Did you outgrow your timeshare and now you want out? But you can't. You can't sell it, and you can't get out of the contract. Imagine trying to get out of your mortgage. That's what a timeshare is. You can't just call up the bank and say, I don't want to pay it anymore. But we may be able to help you do just that. Listen, a timeshare maybe for you once was a great thing, but now you don't use it much. And they are not easy to get rid of. Plus, you do have to pay for it every month. Qualified timeshare owners can get out of their contract legally and permanently without ruining your credit or even filing bankruptcy. And imagine no more mortgage payment or fees. Call the Timeshare Exit Hotline qualification line now. It's free to learn more.
800-455-7967. 800-455-7967. 800-455-7967. That's 800-455-7967. Paid for by Timeshare Defense.
It happens all over Massachusetts. In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
Hi, I'm Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts provides thousands of hours of voluntary services at our VA medical centers and soldiers' homes and is the only DAV department in the country to lead a veterans housing initiative for both single veterans and those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Hi, it's Chuck and Mike from the Armstrong Advisory Group, and we have a guide available this month titled How to Build a Retirement Budget. Mike, one of the issues that we've seen for retirees in the last several years is significantly higher home insurance premiums and property taxes going up as well. How do people attempt to navigate this but still stay within the budget they had laid out for themselves?
Yeah, look, the cost of home ownership, I don't think this is a surprise to anyone. Whether you are buying a home for the first time or you are just seeing those insurance and tax rates that you mentioned going up, it is really impossible to avoid. And I think that's where that flexibility in the budget comes in and needs to be recognized. Because, for instance, you might have factored in a huge cost savings by moving to Florida a decade ago.
Sure.
A lot of that has been eaten up over the course of the last several years. And so you have to have a budget that can evolve with your lifestyle over time.
How often do you review that budget?
I think it's important to at least get a grasp on it once a year. And you can really see costs fluctuate a lot during those periods of time. But those flexibility points are really important because you have to account for inflation, and different things inflate at different rates. So, for example, you might see that your costs of healthcare rise dramatically in your later years, both because you need more of it and because healthcare costs inflate faster than other types of costs. And you have to build those into the budget, even though you might be paying nothing for them today.
This month, our guide is titled How to Build a Retirement Budget, and the way to request it is by calling 800-393-4001. The guide again is How to Build a Retirement Budget, and the number to call is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The Financial Exchange Show podcast drops every day on Apple, Spotify, and iHeartRadio. Hit that subscribe button and leave us a 5-star review. You're listening to the Financial Exchange Radio Network.
Well, in honor of Bill Belichick's 73rd birthday today, we asked the trivia question, which college football team does Belichick currently coach? That would be the University of North Carolina. Winner today of the Financial Exchange Show t-shirt was John from West Hartford, Connecticut. Congrats to John. And we play trivia every day here on the Financial Exchange. See complete contest rules at financialexchangeshow.com.
Piece in CNBC today, U.S. vehicle supply is falling amid tariff fear buying. And basically what it shows is that over the course of the month, we have gone from 91 days of inventory for new vehicles being available in the United States down to 70 days. Used vehicle supply, which is obviously different, that declined by 4 days to 39 days of inventory. And so, look, we've seen an uptick in the pace of buying. We've also seen a number of companies that have said, hey, for vehicles that we are importing, we're pausing those imports right now because we don't want to bring them in and pay the tariffs at the current 25% rate. And so you've got something here that, look, for auto dealers in the short term, it's good news for them. There's no doubt about it. People are making more of these big ticket purchases, but it comes with the question of, what do auto inventories look like 30, 60 days from now? And do we end up back in weird supply chain mode from 2021 in some areas that then has all these ripple effects that go out into other parts of the world economy?
Yeah, that's the $30 trillion, which is our GDP, which is why I use that number.
It's a good
number. That's a $30 trillion. It's a great number. Question. The havoc that these tariffs wreak on various parts of the economy is just very difficult to get your mind around because of all the complexities and interconnectedness of suppliers, and as is referenced in the article. I mean, this is pulling demand forward. We could get a big pop in GDP as a result, but because it's pulling demand forward, inevitably there's going to be a vacuum on the back end of this.
And these have, again, kind of all these weird different things that it's not linear the way that this happens. I'm going to read this quote again just because I think it's viable. This is from the Bloomberg has a podcast that they do called the Odd Lots podcast, and this is from a couple years ago when things were getting nutty in supply chain world. Oddly enough, he told a story about gelatin. They were having a hard time getting gelatin in Mexico, and it's like, why can't we get the gelatin? Well, they're not slaughtering as many hogs, and they're not slaughtering as many hogs because they don't need as many hides from the hogs that they use to make cars, and they don't need as many hides because they're not making as many cars, and they're not making as many cars because there's a semiconductor shortage. And so basically the reason that we're having trouble sourcing enough gummy bears is because of a semiconductor shortage. Like, that's the weird kind of stuff that you end up seeing in these big supply disruptions. It's not just like, hey, there's not enough Kias because they're imported. It's, no, like, we can't get, like, gummy bear prices are rising, or, gummy bear supply is declining. I'm not saying that's what you're going to see now. I'm just saying you get all these weird dislocations because it's rare to find one product where its impact is only felt in that specific industry.
Yeah, we just take for granted how complex the global economy is and how interdependent we are. We may not want to be, but that's the state of things. And a lot of people would argue, myself included, it's made us better off on average. There are some problems. They could be corrected in different ways. This brute force approach, this sledgehammer tariff approach, it has unintended consequences, as you've pointed out, and some very foreseeable consequences, too.
So we'll see what happens in the auto sector, but obviously auto dealers, certainly like everything that you're hearing is that they're busy right now. One other note, just in terms of like these unintended consequences and how we don't know exactly how this is all going to play out. I was talking with a couple buddies of mine last night just about like continued, what's going on with tariffs. They're both in businesses where they import a bunch of stuff from China in the consumer space. And one of them is continuing to tell me, he's like, I'm seeing more orders canceled from my retailers that buy my stuff. Like, I'm going to have to start laying people off. The other told me, hey, like, it's not perfect, but I was actually able to negotiate a decent enough price where, yeah, like my margins are going to be impacted, but my shippers are eating a ton of the cost. China's eating some of the cost, and I'm going to have to raise prices a little, but I think I can, and we can make it work on the stuff that we're importing from China, but everyone's margins are getting shredded in the process. He's like, I'm getting like huge discounts from my shippers that just want to basically keep things moving, because if they shut down those routes, it's like you can't operate a shipping fleet if you just stop sending ships. I know that sounds kind of reductive, but it's what it is. Like, you have to keep the boats moving. So, again, kind of mixed things where one business is saying, yeah, we were able to get to kind of an agreement where no one's going to be happy, but we're going to be able to keep supplying stuff. Another one's saying, yeah, I'm seeing all kinds of orders canceled. So it's a mixed bag. There's no one size fits all. It's different in every industry, every business, and we're seeing all kinds of different things here at the moment, at least.
Consistently voted one of the top Caribbean destinations, the United States Virgin Islands is the perfect place for your next vacation. Whether you're looking for a romantic getaway, a long weekend with friends, or a family vacation, St. Croix, St. Thomas, and St. John have everything you need to enjoy that special time away from home. Take advantage of a variety of incredible promotions that are available right now. Go to visit usvi.com/promotions, where you'll find details about all of these amazing experiences, including a stay at the Divi Carina Bay all-inclusive beach resort and casino on St. Croix. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Don't miss your chance to enjoy America's Caribbean paradise, the United States Virgin Islands. Head to visit usvi.com/promotions for more information and to book your trip today. That's visit usvi.com/promotions.
Mark, one of the things that we've seen in the last couple weeks now is with mortgage rates moving back up, a bigger percentage of prospective homebuyers turning to adjustable rate mortgages in order to try to keep those interest rates as low as possible, at least at the outset of their loan. According to data from the Mortgage Bankers Association, the adjustable rate mortgage share for last week was 9.6% of new loans that were applied for, and that's the highest since November of 2023, and basically like a 2% bump in the last 3 weeks, which is just a pretty rapid shift there. Now, to anyone wondering, hey, is this going to come back to bite us like it did in the financial crisis? Couple key differences. The first one, underwriting standards remain rock solid, like by and large. You see very, very high underwriting standards, so that's one key difference. The second is still just a matter of scale. During the run-up to the financial crisis, at the peak, about 40% of all loans that were being underwritten were adjustable rate mortgages. This is still less than 10%. So it's not comparable both in terms of the quality of loans and even the percentage of them that are adjustable rate. There's no comparison to what we were seeing in the early 2000s.
Well, with long-term rates rising more than short-term rates, it makes sense that more people would use this tool.
Entirely.
So it's not a surprise.
Yeah.
The issue is more, to me, not the interest rate spread. during a crisis, the rate at which you may have to refinance when your loan resets, that's important, but it's not as important as whether or not you have a job. So the real problem during the financial crisis was unemployment went up to 10-ish%. I forget whether it was closer to 11 at that point, 10.2, I think, something like that.
Let's take a quick break here. When we come back, we'll do a little bit of Stack Roulette.
The global trade war is in full swing. How long will it last is anyone's guess. Keep it here for the most up-to-date information plus breaking news every day, right here on the Financial Exchange Radio Network.
The breadth of the stock market sell-off in recent days hasn't been seen since the early days of the pandemic. And while it's easy to say don't panic, if you're concerned about your portfolio, given the impact of these tariffs, now's the time to have that conversation. Hi, this is Mike Armstrong from the Armstrong Advisory Group. If the market correction has you anxious, or worse, rattled, give us a call at 800-393-4001. Let's get together and talk through your financial strategy, evaluate its strengths and weaknesses, and make decisions for the future that are in your best interest. These are challenging times, but we've dealt with them before and are prepared to deal with them again. Our goal is to help you protect the assets that you've worked so hard to attain. You can give us a call at 800-393-4001 and request a no-obligation consultation. That number again is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Consistently voted one of the top Caribbean destinations, the United States Virgin Islands is the perfect place for your next vacation. Whether you're looking for a romantic getaway, a long weekend with friends, or a family vacation, St. Croix, St. Thomas, and St. John have everything you need to enjoy that special time away from home. Take advantage of a variety of incredible promotions that are available right now. Go to visitusvi.com/promotions, where you'll find the details about all of these amazing experiences, including a stay at the Divi Carina Bay all-inclusive beach resort and casino on St. Croix. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Don't miss your chance to enjoy America's Caribbean paradise, the United States Virgin Islands. Head to visitusvi.com/promotions for more information and to book your trip today. That's visitusvi.com/promotions. It's easy to say that you're simply leaving your assets to your children, but without proper beneficiary planning, it can cause significant problems. Call Cushing & Dolan at 866-848-5699 and get their new guide called How to Leave Assets to Beneficiaries. Don't leave your future or your children's future to chance. Call 866-848-5699 or request it online from our website, legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
Heads up, athletes, coaches, and parents. Play for life, not just points. Hypertrophic cardiomyopathy, or HCM, is the leading cause of sudden cardiac death, especially in black athletes in sports like football or basketball. If you feel shortness of breath, chest pain, and fatigue, or have a family history of HCM, talk to your doctor. Don't let HCM bend you for good. Learn how to stay in the game at heart.org/HCM student athlete. Your heart, your health, your move.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Like us on YouTube and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network.
The Financial Exchange is proud of our partnership with the Disabled American Veterans Department of Massachusetts. This year's 5K is Saturday, November 8th, and registration is now open. The race has sold out each of the past 4 years, and slots will fill up quickly, so don't delay. Visit dav5k.boston today and reserve your spot, or join our team here at the Financial Exchange by registering under Team TFE. That's Saturday, November 8th for this year's DAV 5K. Sign up now at dav5k.boston.
Mark, you ever been to the Coachella Music Festival?
Don't lie, Mark.
I don't even know. I thought the way you started that sentence, I thought it was an Italian restaurant. So,
have you ever been to the Coachella Italian restaurant?
Probably.
So, for those of you not familiar with it, Coachella is a big music festival out in the Coachella Valley of California, and they get, I think it's like 100,000 people a year that go out there and party it up and have a great time and everything.
Oh, it's Spanish. Sorry.
What's that?
It's Spanish. I'm sorry. I don't know why I said that out loud. It's Spanish.
What is Coachella?
Okay. Well, it should be Coachella, I guess.
I'm like, it's Spanish. What is? I don't know what we're doing here. Anyways, so it was $600 for tickets this year. But basically, in order to get lodging and everything, the cost can be significantly higher. And this is obviously something that targets mostly people in their 20s and early 30s. And the thing that is fascinating here and horrifying at the same time, approximately 60% of general admission ticket buyers at this year's festival opted to use Coachella's payment plan system, which requires as little as $49.99 upfront for tickets to the annual concert. And this obviously, leads you to like the thought of, hey, if you're going to a concert and you can't afford the tickets, you probably shouldn't be going to the concert. It's kind of a nice baseline place to be. Now, you might say, oh, well, is it like interest-free financing and blah, blah, blah. And the answer is no. Like, you have to pay upfront. It's a $20 finance fee in order to get started on the payment plan. So you do the basic math, and that's for a 3-month plan. And so you say, okay, I'm paying $20 on a $600 purchase. That's 3% over 3 months. I'm paying like 12-15% annually in order to go to this concert here. And again, then you have, other fees. There's another one that's a $41 fee that gets charged by someone else on this on top of that. So all of a sudden, you're sitting here and you're like, I'm paying 10% on over 3 months in order to do this payment plan. If you can't afford to go to the concert, don't go to the concert. There's going to be another one.
Not with this lineup, man.
It's true. Those people will never be there at the exact same time ever again. But like this is the very definition of a discretionary item. It's a $600 concert. And if you can't afford to go to it, paying, $60 in interest over 3 months is not the answer.
Great advice, but anybody who's hell-bent on going is not going to listen to that advice.
No, I get it.
Right?
I get it.
Not to mention, like, once you get in the door, like, or the gates or whatever, like, all this stuff you got to be buying inside. Like, that's just for the concert you're talking about.
Yeah, exactly. So, I mean, look,
you're easily over.
And don't get me wrong. Like, in my 20s, I had plenty of really dumb things that I did, too, as well. I mean, I can tell you about times where, like, I was 22 years old, and I'm at the casino, and I'm like, well, if this one doesn't pan out, I don't know how I'm going to pay the rent this month. Like, I get it. We've all been there. But make the mistake once and learn from it. Don't do it again, man. Because, again, like, we've all had, like, the times where we've done, dumb financial things. And
yeah.
I get it. Like, I'm not trying to say that I'm better than anyone. Like, no, I've had those same dumb things that have happened. But it's much more, hey, learn from my dumb experience so that you don't have to experience it yourself.
Wow.
Yeah, I'll do that for you, Mark. What else you got
I was
for
going
me?
to say, we know who not to room with if we ever go on a financial exchange excursion.
It was a long time
we know who
ago.
we're not going to be splitting costs with.
It was a long time ago, Mark. I've reformed my ways.
The administration's in a spat with Harvard. We're obviously not going to get into that. I thought it was interesting, though, as reported by Bloomberg, and it's a front page, a web page anyway, Bloomberg story about the dependence of the Massachusetts economy. It's a little Massachusetts-centric, sorry, but this applies to other cities that host universities, right? If you're listening in Rhode Island, this applies to the east side of Providence and beyond. So yeah, there are plenty of parallels. But in Massachusetts, our economy has a GDP, gross domestic product, the value of our goods and services of about 650 or so billion. Colleges and universities are estimated by a study done at UMass to provide more than 320,000 jobs and generate more than 10% of our GDP. They estimate about $70 billion is poured back into the local economy by colleges and universities. I don't know how that stacks up. Bloomberg doesn't give me the data, and I couldn't find it in a cursory Google search, but I suspect that is quite large given the presence of big universities and the research that they do and their importance to our state. I didn't think it was anything near more than 10% of our GDP, though. So not much of a breaking story there, but a reminder, at least to those of us here and maybe elsewhere, of how intertwined local economies are with colleges.
I don't know if anyone's really been paying attention to it, but there is a big antitrust trial that's going on now with Meta at the moment. And some of the stuff that is coming out during it, I've been following it over the last couple of days since it kicked off. And it's kind of remarkable that they have emails from Mark Zuckerberg being like, hey, we need to buy WhatsApp because otherwise they could really compete with us in the social network space.
Whoops.
Like stuff like that that's, pretty aggressive.
Smoking gun.
And this is exactly what we talk about when I talk about antitrust. It's the fact that, a lot of it is almost invisible because, A, Meta's a free service. Like, you don't pay to use Instagram or Facebook or WhatsApp. And so you're like, okay, what's the cost to me? But I'm a big believer that the cost is that lack of competition for users and the improvements that could come from it. And when you have companies, literally senior executives saying, we need to buy these companies so they can't compete with us, it is the very definition of anti-competitive behavior.
I almost don't believe he could have put that in an email. I know we saw it.
Yes, we have seen it.
It seems beyond irresponsible and stupid. Someone at his level should know you don't put, of all things, that in an email. Like, if I put that in an email, you would politely let me go.
You're sure that he's thinking it, but you wouldn't expect him to, like... You ever watch The Wire?
He's thinking it. No, I haven't, but...
Great line in it. All the drug dealers get together, and they're, talking about how they're going to get their business spooled back up, and one of the guys is taking notes, and the leader goes... Man, you taking notes on a criminal conspiracy?
Right.
Like, that's what they did. That's what Zuckerberg did.
Right.
So it's wild to me. I still have no idea if it's actually going to end up resulting in any consequences for Meta because it's been a while since we've seen any consequences for big tech in any meaningful fashion. But they literally documented, hey, we're going to buy companies X, Y, and Z because otherwise they could compete with us. My goodness. Let's take a quick break for the entire rest of the day. Hope you all have a great rest of the day, and we're back at it tomorrow with more Financial Exchange.